Investors now looking ahead to those key earnings reports and who is really delivering value, growth, and returns. With me now to discuss, Rick Heitzmann of FirstMark Capital. Welcome back.
Thanks, Scott.
Good to have you back.
Yeah.
That's what it's going to come down to, right? Like a lot of, it was a rising tide, lifted all boats last year.
Yes.
Now we're going to see which boats are good.
We're going to see who's wearing a suit when the tide goes out. And I think we're going to see who's delivering real value. And in an up market, as we talked about everything from stocks to bonds to real estate last year, what's really going to happen and who's delivering real value in 24.
You think it was too much hype, or did you look at it and say, no, it's totally justified? This is a transformative technology. The kind of guidance that people like NVIDIA gave out was just astonishing.
It was too much hype across the board when people said AI is going to lift all boats, or prospective falling interest rates is going to be great for everybody. It's going to be great for some people, but it's not going to be great for everyone. You still have to put up the results, and that's why I think this year is going to be a year where it's a real stock picker's market.
You look at any one of the so-called Mag 7 and say that's the one I've really got my eye on this year, because for better or worse. I mean, you see there's at least been some divergence between the performance, right?
Exactly.
Apple seems to be under a little more scrutiny this year, whereas kind of everything went up last year. And NVIDIA's run again right now has been remarkable in and of itself. The stock just keeps going up.
Well, at least NVIDIA has great fundamentals, right? They were blowing through their guidance. People are still on the AI train and haven't figured out what it's really going to be for them, but they feel like they need to get as much as they can from NVIDIA. You know, Apple, their PE doubled last year, but sales were down. And now you're seeing some troubles in China, some other things. Maybe that was a little bit overblown. If you look at the fundamentals, they're already selling more phones than anyone else in the world. How many more phones could they sell? Whereas someone like Microsoft, now integrating things like Activision, have a consumer portfolio, have an enterprise portfolio, are dominant in large parts of the market, seeing a lot of growth from Azure, they might seem to have greater earnings upside.
So I would imagine, in the lens that you look at the tech world from, private market valuations have a massive correction.
Yes.
And, public market valuations in tech really didn't. They expanded.
Correct.
So because the private markets went through the pain first, what happens now?
They lagged the pain, then went through a lot more pain. So they haven't rebounded the way the public markets did last year, but everybody kind of had an ugly 22. And then we didn't see the bounce in 23 in the private markets. And what you're going to see in the private markets, largely because there's no shorting, there's no trading in and out, you're really going to see who's delivering value for their customers, who's really able to drive growth from both a top line and bottom line perspective, and which are really the great companies that are taking advantage of everything from AI to cloud infrastructure.
Are you being more discerning in what you look at and what kind of willingness you have to invest in ways that you maybe weren't, with the scrutiny wasn't quite that rigid over the let's say 3 years ago?
I would say 3 years ago, scrutiny might not have been as rigid. The market was moving so fast. And obviously, like everyone else, we tightened our strike zone. We doubled down on diligence. We were much more thoughtful about what we were doing, and whether it related to pricing or the types of people we're getting into business with. And we're making 10-year commitments on these investments. We're not able to trade out of them if we decide we changed our mind. So these are deep commitments that are long-term commitments, and therefore we made a lot more stringent decisions. But that's gone on for a couple of years, and now hopefully we're going to see the benefits of it in 24 and 25.
Talking about some of the earnings, the mega caps suck all the oxygen out of the room, but you have your eye on others. I'm not sure if you've invested in all of these companies, but DraftKings, you were early
investor,
early there. So I don't know what your expectations are there, but Vacasa, CCC, Intelligent Solutions, and Rover.
Yeah, there were a bunch of different trends. If you'd say, hey, we're throwing the babies out with the bathwater, a couple of those were SPACs. So, they were SPACs that people said, hey, I don't want to invest in SPAC stocks. They don't have support. They're never going to make it. Well, DraftKings has proven, although they went public via a SPAC, it's how you were born, whether you were, it doesn't matter. It's how you're performing in the public markets. DraftKings did a great job, and Jason did a great job of not only driving revenue, but earnings. Vacasa has continued to hit their numbers and have been undervalued largely because they're a smaller cap stock. CCC has a great long-term business with great moats, but people might have overlooked them because they were a SPAC. And now I think the best investors are going back saying, hey, did people paint these with too broad of a brush, and now we have to get granular on what the quality of the business is.